You're watching Dukascopy TV. I'm Elaine Stenson. Slovenia is currently struggling to avoid becoming the next Eurozone country to seek an international bailout, with banks dealing with €7.8 billion of bad loans, equivalent to almost a fifth of economic output. The question is, can this Eurozone economy fix itself without the help of foreign funds? Vladimir Vano, Europe economist with Sberbank, joins me on the line now. Vladimir, how bad is the situation in Slovenia currently?
Basically, Slovenian banking sector got into this trouble due to the previous recession, which caused a significant increase in non-performing loans, especially in the construction sector, which was a bit overbloated in Slovenia, similarly as in some other countries, including Ireland or Spain. One has to keep in mind, though, that a big portion of this amount of non-performing loans, which created this hole that needs to be filled by increase of capital of majority state-owned banks, big part of those non-performing loans have been covered, so the net liability or net capital increase that is required might not be as significant. And obviously the question thanks to which Slovenia got on the radar or in the main question due to which Slovenia got into the spotlight of international community is whether the government would be able to raise that amount of money within the reasonable time to be able to fill this gap without the need to draw international assistance.
The Slovenian Prime Minister Alenka Bratušek said, "We don't need any outside help. We know how to solve the problems and we're going to do it." Meanwhile, the ECB President Mario Draghi has urged Ms Bratušek to take more decisive action, even though she has already imposed certain reforms, including a tax increase, a major restructuring of Slovenia's ailing banking sector and a programme of mass privatisation. Vladimir, what is your response to this? Is the Prime Minister being realistic, and can Slovenia get back on track without seeking help?
Difficult question. Let's start with the autumn assessment of the European Commission, which was broadly positive on the outlook for the Slovenian public finances in the next year. Also, the government or the parliament, despite hesitations, did pass the proposed fiscal reforms that Ms. Bratušek government has proposed. Moreover, and that's the most important in answering the question whether Slovenia will be able to avoid drawing the international assistance, the most importantly, Slovenia has repeatedly proven that it is able to raise the money to refinance its public debt. In May, it held two successful US dollar government bond issues on international markets, even though at a price at relatively elevated levels of yields raised. But as recently as in the middle of November, the government of Slovenia was able to raise 1.5 billion euros of 3-year Eurobond, again with a yield of 4.7%. But still, it proves that Slovenia at the moment is able to refinance its the debts that are due, and also the further borrowing that might be needed to fill the gap in the banking sector on its own. The most recent signals, both from the government and from the Central Bank of Slovenia, do suggest that they will do what's feasible to resolve the situation on their own.
Okay, Vladimir, and over to Portugal now, another country that's struggling to avoid a second bailout, which if they don't enter into, they will at least have to accept the credit line that is being made available to them as they exit the current bailout. Vladimir, how necessary is it for Portugal to accept a credit line, one that Ireland refused only a few weeks ago, and should they enter a second bailout?
First of all, some of the critics are associating the bailouts of so-called Troika or European Stabilization Mechanism, which is this the vehicle through which the European countries are helping to each other in the period of temporary liquidity issues. Some critics are associating this mechanism with moral hazard, and exactly the attitude not only of Portugal, but also the earlier attitude of Ireland to this sort of multinational assistance does suggest that accepting an international bailout is not a free lunch. Basically, even though the international bailout from European Stabilization Mechanism is effective way how to bridge the temporary liquidity issue in refinancing the public debt, and it helps the countries to refinance the obligations that are coming due at relatively reasonable interest rates, and gives the countries the breathing space and the window of opportunity to carry out inevitable and painful economic reforms, both in terms of public finances and structural economic reforms. But when the bailout comes, this breathing space and this window of opportunity that this bridge loan is giving to the countries comes with significant strings attached, and those strings are very strict requirements regarding both reforming the budget as well as structural reforms in the economy, which are evaluated on a rolling basis, and actually basically drawing each subsequent quarterly installment of the bailout is associated with strict assessment of how the previous homeworks have been fulfilled. So it really, the strings attached to the bailout are significantly restricting the maneuvering room from the government, which basically has to comply with the homeworks that come from Troika, which means the European Commission, European Central Bank, and the IMF, which are the three partners which overview the requirements associated with this bridge bailout. As far as the Portugal is concerned, I would not run too much ahead. Basically, the current facility is running through the mid-2014, as you correctly pointed out. Ireland was the country which was already this year able to successfully return to the bond markets, thanks to which it is gradually exiting the bailout facility that was provided. Basically, because of these strings attached, these requirements, which are evaluated on a quarterly basis, the governments are trying to do their best to avoid slipping into this bailout mechanism, or are doing their best in order to exit this bridge loan as soon as possible. And the only way how to exit the bridge loans from the European Stabilization Mechanism is to push ahead with the fiscal and structural economic reforms as hard as possible in order to convince the bond markets that the country is again a viable lender.
Vladimir Vano from Sberbank, thank you for joining me on the line today, and that's all from me for now, but do check back later for more updates and interviews from the team. Bye for now.